In my opinion, QQQ is one of the best ETFs out there. Clearly, the performance has done really well over the last 5 years. It's up 160%. This ETF is primarily geared towards growth and growth in large companies, and it's seemed to provide that, right? It has a track record of doing that. It also, if you've heard of the NASDAQ 100, this ETF just tracks the NASDAQ 100. So we can see since 2014, late 2014, so over the last decade, it is up from 108 to 526. This ETF has outpaced the S&P 500 pretty dramatically. That is really good. And we can see here on the list, its historical return is high. It's difficult to find ETFs or stocks in general that have outperformed it, but certainly ETFs that have outperformed this performance over the long run. And it is labeled historical risk above average, but that is primarily just because it is geared towards growth. So what that means is these stocks are growth-centric stocks, which means they are growing rapidly, but also they demand higher PE premiums, which basically just means these stocks are growing fast, but also you're paying a premium to have them. So when there is a market downturn, like a recession, QQQ is going to go down more than the average ETF or average stock, certainly more than something like Schwab Dividend, which I've covered on this channel, but primarily it's trying to give you dividends and then some growth on top of it. So if you are, let's say, 5 years out from retirement, right, in your 401k, you would not want everything to be in QQQ. Ideally, you would never want anything to be in just one ETF, but I would diversify. Obviously, you want some bonds and stuff like that. So with QQQ, I love this ETF. Like I said, the only risk I would be hesitant of is if you are close to retirement, right? And the vast majority of your 401k is just in QQQ, because it also depends on how much money you have. I can't speak to every single one of your situations, but just know that if there is a market downturn, QQQ will be down more than the average stock or ETF, but it will do good in the long run. So if you're 20 years, even 15 years away from retirement or plus, QQQ being a large portion of your 401k shouldn't be an issue, right? I cover single stocks on this channel along with ETFs, and clearly we don't have to talk about, risks with single stocks because ETFs are diversified into many different companies. And we can see a lot of these companies, certainly in QQQ, are in IT. It is half IT companies or tech companies, and that is good because primarily the growth driven over the last certainly 15 years, but probably more than that, has been driven by tech companies. Tech companies have thrived, from the Apples. I mean, we can just even look down the list, right? Apple, Nvidia, Microsoft, Amazon, Meta, Broadcom, Tesla, and then there's some in there like Costco has performed well as well, but primarily this is a tech-centric ETF. So if you balance this out with like, Schwab Dividend, which is, value, it's more on the value side. We can see this chart here. This maps it out pretty well. So like value is, cheaper. Maybe they don't grow as much, pay a higher dividend. It is 12%. So there's some, but primarily you're in a blend or growth centric, large stocks. So yeah, like if you bounce it with a Schwab Dividend, you would get some more of that value. So but like I said, you really just got to find, the risk reward ratio for you. And then also, I wouldn't mind having a large percentage of my 401k in something like QQQ, but you also have to factor in, okay, you have almost no small stock exposure. And you may say, why would I care about that? Well, if you look like long term, like over the last 60 years, maybe even longer than that, historically, small cap stocks have actually done really well. Now, over the last, certainly since COVID, if you look at something like, the Russell 2000, I was struggling to think of it. Something like the Russell 2000, that is primarily small cap stocks. And it is done, you can look that up if you want to, it is done not well at all over the last 5 years or so. I mean, I'm not going to speculate exactly why that is in this video, but I would want some form of small cap exposure over the long term for me and my 401k personally. But of course, this is up to you guys, and I'm not going to tell you what to do. So yeah, I think that's covered most of it. There is an expense ratio. It's moderately high, so you'll be paying 0.2%, payment for it for owning this, but that's not crazy. It's not high, but it's not crazy low either. So that is something to factor in, but I really wouldn't be too worried about it. I mean, it'll eat into things a little bit, but very, very small over the long run as well. So, and you can see some ratings here: 5-star, 3-star for the most recent rating for the last 3 years. I'm trying to say, and over the last 5 years, it has 5-star and 10-year. It's also 5-star. Yeah, it's performed very, very well over the last 5 years. And if you zoom out, right, it's just good. I like it. QQQ, it's going to do fine. It's going to do you well. And historically, it's been outperforming the S&P 500 actually pretty dramatically. And I like the S&P 500 as well. That's a good baseline to look at. So, like I said, this is a good long-term growth ETF. It's just a little bit more risky in the sense of, okay, it'll go down more during recession. But like I said, if you're investing for 10, 15, 20 years out, shouldn't worry about it too much. Even the worst recessions usually only last 5 to 6 years on the stock market. But if you're getting closer to retirement and you're like 95% QQQ and you need some of that money for retirement, that would be a little bit risky, right? So, but anyways, I appreciate all of you for watching this video. I hope you enjoyed. If you're new, leaving a like, that would help out the video performance, and I would appreciate that a lot. Also, if you want to catch similar content on my channel, I'd appreciate if you subscribed. I do daily stock content on this channel, from single stocks to ETFs to dividends to basically everything. So I appreciate you all for watching, and I hope to catch you in the next video.